It's great to be here this morning with everyone to talk about a topic that we've been working a lot with. It's kept us very busy over the past few months, and I know it's probably kept a lot of you very busy as well. Today, we'll be talking about provider relief funds and discussing the terms and conditions and related reporting requirements for the provider relief funds. How your organization can prepare for a compliance audit. I know we've gotten a lot of questions on, when is a compliance audit required? What does that look like? So we'll be discussing that, as well as briefly touching on the phase 4 application process. So Lauren, go ahead and switch the slide. And as Lauren mentioned, I'm Courtney Bach. I'm an audit shareholder here at LBMC, working exclusively with healthcare companies. And probably about a year or a year and a half ago, we formed a provider relief team just to help keep up with all the guidance that was coming out so that we could, answer questions as clients had them. So I'm a part of that provider relief team, and we meet, weekly, if not more often, to talk about everything because there's a lot to navigate here. Go ahead and switch the slide, Lauren. Wasn't going to spend a lot of time talking about the background of the provider relief funds because I'm sure most of you are very familiar with that. We've heard about this. It's been around for a while. Just wanted to hit some highlights there. There's over 186 billion in payments to be distributed through the provider relief fund. And this visualization, represents the list of providers that received a payment through the provider relief fund and who have attested to receiving one or more payments and agreed to the terms and conditions. So you can see, from April 10th, 2020 to date, about 119 billion of organizations have attested to receiving those payments. And those have really come through general and targeted distributions. And there's been 3 phases of funding that's been provided. And phase 4 applications are now open. And the deadline for those is October 26th, so next week, with the goal, HHS says the goal is to distribute those funds by the end of the year. So as far as the terms and conditions of the provider relief funds, it states that the funds should only be used to prevent, prepare for, and respond to coronavirus, and shall reimburse recipients for healthcare related expenses or lost revenues attributable to coronavirus. And non-compliance with the terms and conditions could result in recoupment of some or all of the provider relief fund payments. So wanted to spend a little bit of time talking about the reporting requirements. There's a lot of guidance out there. A lot of things have continued to change related to this, but these reporting requirements are specific. They tell you when you have to report on the funds you received and what that reporting looks like. And so you can see from the table below, the period 1 payments are those payments that were received between April 10th, 2020 and June 30th, 2020. The deadline to use these funds was June 30th, 2021, and the reporting time frame was July 1st, 2021 through September 30th, 2021. And we'll talk a little bit about some changes to that on the next slide. I think the other thing just to note here is period 2 payments. Those will be required to be reported on beginning on January 1st, 2022. So organizations have until the end of this year to use those period 2 payments. So as far as the period 1 reporting, on the next slide, I've just included the grace period that was issued. This was issued in late September by HHS, just granting a 60-day grace period for that period 1 reporting. So instead of having to report everything by September 30th, organizations now have until November 30th to report on their period 1 provider relief payments. This takes us to our first poll question. Have you completed your portal submission for period 1 provider relief payments? Yes, no. Did your organization not receive provider relief funds, or were you not required to submit based on the amount of provider relief funds received? And not going to keep this slide on, but you should have a minute to answer this poll question, and we'll just continue to move on, and then we can look at the results later. So I wanted to specifically talk about some of the terms and conditions because those do impact the reporting on these provider relief funds. You know, the guidance says that you have to first use the funds on eligible expenses. And I think there's been a lot of questions and confusion as to what's truly an eligible expense. So there's really two questions that are important to think through as you're trying to determine if an expense is eligible for the provider relief funds. The first one is this expense necessary and reasonable to support patient care efforts to prepare for, prevent, or respond to coronavirus? And is the expense incurred consistent with the organization's policies and procedures? And so I think another important thing to just think about is, was the expense incremental? You know, there is a lot of guidance out there that HRSA, the Health Resources and Services Administration, and HHS have put out. They actually have an allowable expense kind of guide that they've given, and it lists the general and administrative expenses that can be used for the provider relief funds, as well as the healthcare expenses. And some of those examples would be, you know, personnel costs, fringe benefits, you know, rent for an additional facility that the organization acquired or had to see patients, personal protective equipment, IT costs, telehealth costs. So it does give specific examples to those, and just making sure you think about, was this an expense incurred to prevent, prepare for, or respond to coronavirus? And is it an incremental cost that the organization incurred? And there's a lot of frequently asked questions out there related to expenses that HRSA and HHS has released. I was going to cover just a couple of those that I know we've gotten a lot of questions on, and I think that are pretty helpful because they do apply to a lot of organizations. You know, I think one of those is capital assets or equipment. If an organization purchases a capital asset or equipment or something related to coronavirus, can that entire cost be included in the use of the funds? And the answer is yes. You can claim the entire cost in the case where the purchase was directly related to prepare for, prevent, or respond to coronavirus. Another helpful question is, can reporting entities claim time spent by staff and director level resources on specific COVID matters, such as task force meetings or preparing their organization's COVID response? And yes, that may be an allowable cost as long as it was not reimbursed by another source. And so I think the important thing there is just making sure your organization has good documentation on, you know, how you determine the amount of time that those employees spent on COVID. You know, was there something that specifically they tracked their time with, and just having that good documentation for your records. And the last question, or frequently asked question, is, are expenses related to securing and maintaining adequate personnel reasonable under the provider relief funds? And yes, expenses incurred to secure and maintain personnel, such as hiring bonuses, retention payments, or other forms of payments, are deemed COVID related if the activity generating the expense was newly incurred after the public health emergency and the expense was necessary to secure and maintain adequate personnel. So I think if you have specific questions, it's helpful to go into the frequently asked questions that HRSA has put out there. They update those regularly. I think there was an update at the end of September, so they're continuing to add updates to that. And I'll go back to the polling question. It does look like there's about 19 people that have submitted, or 19% that have submitted their PRF payments, 11 that have not, and then 56% that did not receive, or 14% that are not required to submit. So after you've gathered all your expenses, the next thing to look at is lost revenues related to the provider relief funds. And this guidance has changed quite a bit. I think June was the latest that they came out with the kind of ultimate lost revenue calculation, which says that you would calculate your lost revenues for each quarter during the period of availability as a standalone calculation. So if you had revenue losses in one quarter, those would not have to be offset by revenue gains in a different quarter. So that was very beneficial to a lot of organizations. And HRSA has actually issued a lost revenue guide, and it walks through the different options you have to calculate your lost revenues. There's 3 options. This table here kind of goes through those specific options. So it gives examples of those options, and it also gives specific examples of items that you would exclude from your patient care revenue. I think some of the frequently asked questions we've gotten related to lost revenue calculations, one relates to option 2, if you are trying to use your budget to calculate lost revenues. There's been a lot of confusion there, and the lost revenue guide ultimately says that if your budget does not cover the entire period of availability and was approved before March 27th, you should not use option 2. You would have to use option 3 for your budget. So a lot of organizations, their budget does not cover past the 2020 calendar year. And so that would then put you into option 3 for reporting. And I think there's another FAQ that's helpful is there a maximum amount of provider relief that can be used for lost revenues? And that answer is no. There's no maximum amount that can be allocated to lost revenues with the provider relief funds. A few other reporting requirement considerations, if you haven't gotten in there and looked at it, is there's a lot of information that they're requesting, some metric information, personnel metrics, facility metrics, and patient metrics. And so just making sure as you're gathering that for the required periods, which is Q1 2019 through Q2 2021 for this period 1 reporting, that you're gathering it on a consistent basis. So those numbers are consistent from quarter to quarter. And there is a reporting user guide that does help kind of give definitions of what exactly they're looking for those metrics. There's also some reporting worksheets out there that HHS has released, and it's a workbook that has separate tabs, and it really helps you follow through the provider relief portal. So I recommend, if you haven't reported, using that workbook to compile your information, and that way it should be easier once you get in there and actually begin the reporting process. There's also other HHS resources out there, instructions, user guides, lots of frequently asked questions. They've held a few webinars. So lots of resources out there if you do have questions or issues as you begin reporting on period 1 or future periods. So let's talk a little bit about the accounting requirements. I know a lot of you probably dealt with this in 2020 as you were working on, year-end financials. On when these funds should be recognized. For a not-for-profit organization, these are considered non-exchange transactions in accordance with contributions received. And so that would fall under Accounting Standards Codification 958. For a for-profit entity, there is not specific guidance on them receiving government grants. And so typically they've used ASC 958 similar to not-for-profit organizations, or there is an International Accounting Standards IAS 20, which does discuss government grants, and that you would recognize those once reasonable assurance has been obtained that the conditions will be met. And these provider relief funds are presented in the income statement separately as other income or as a reduction to the related expense. We've seen them a lot of times, separately on the income statement called CARES Act grant income. And if the full provider relief fund distribution cannot be recognized at the end of the reporting period, the remaining value continues to be treated as a refundable advance or deferred revenue on the balance sheet. So audit requirements, compliance audit requirements, I think this has been definitely a hot topic. Commercial organizations that receive $750,000 or more in annual awards really have 2 options to meet that compliance audit requirement. The first one is an audit in conformance with the requirements of 45 CFR 75 subpart F, which is a single audit, or a financial audit of the award conducted in accordance with government auditing standards. Not-for-profit organizations have to fall under that single audit. So option 1, they would be required to have that. There's also an option under option 1, instead of a full single audit, would be a program specific audit if your organization only received funds through one program. So they only received funds from HHS. And so as far as kind of the audit requirements, the The intent for these audit requirements is that what you report in the portal should agree to what you're reporting in your single audit or your financial audit. This table shows kind of for the period of reporting of the funds, when those would be included in your compliance audit. So you can see the period 1 payments. If you're a June 30th, 2021 entity, you would have a compliance audit as of June 30th, 2021, and it would include period 1 payments. December 31st, 2021 organizations, they will have a December 31st, 2021 compliance audit, and it would include period 1 and period 2 payments. So no compliance audit required for 2020. It will just be starting in 2021. And, for June 30th, 2021 entities, that compliance audit can begin as soon as you've completed your reporting. Part of the compliance audit will be testing your reporting. And so once that's completed is when that compliance audit can begin. So for December 31st, 2021 entities, your compliance audit can begin after you report on those period 2 payments, which the deadline to report on those is March 31st, 2022. So I think this is very confusing for a lot of organizations, just because it doesn't match with maybe how you reported these in your financial statements for GAAP. So there is a disconnect between maybe how you reported them for as of year-end 2020, and then what's going to be reported in your compliance audit. And so these periods really drive the $750,000 requirement. So preparing for a compliance audit, just wanted to touch on this because I know for a lot of for-profit or commercial entities, this will be the first time you've gone through a compliance audit. Just something to note, there are other payments that are subject to the compliance audit that came through HHS besides the provider relief funds. Those are the COVID-19 testing for the uninsured and the COVID-19 testing for rural health clinics. So what is the difference between a single audit and a financial audit? So a single audit is going to be a lot broader in scope. A single audit, an auditor would issue an opinion on your financial statements under GAS and GUGAS. So under general accepted auditing standards and generally accepted government auditing standards. They also would issue an in relation to report on your schedule of expenditures of federal awards, or the CFA. So your audit would include the financial statements, the CFA, and then there would be an opinion on compliance and reporting on internal control over compliance under the uniform guidance, as well as a statement of findings and question costs. So as part of the single audit, there's going to be testing of internal controls and testing of the compliance with the terms and conditions of the funds. And a CFA really looks at, it would include any federal funding you received, and you would have a major program determination where those specific compliance requirements would be tested. A financial audit is where the auditor would just issue an opinion on a specific statement or schedule. So on your schedule of the provider relief funds. So it would not encompass a financial statement audit. The auditor would also issue a report under GUGAS on compliance and internal control over financial reporting. And then a schedule of findings would be included if applicable as well. And so for the financial audit, your internal controls would be reviewed, and then there would be specific testing on compliance. So this is the option. The financial audit is the option we expect most commercial organizations to select as to meet that compliance requirement. The 2021 compliance supplement has also been released, and this is issued each year by the Office of Management and Budget and provides guidance as to what specific compliance requirements are relevant to the federal funding and how you test those compliance requirements. So this really drives the specific testing that'll be required as part of that compliance audit. This is really applicable for a single audit, but we expect a lot of the same compliance requirements for a financial audit. So what can your organization be doing now to prepare for this compliance audit? Go ahead and start gathering all the provider relief fund information, payment information, and supporting documentation on the use of these funds. A lot of that has already been gathered for the reporting. So it's just making sure you have good documentation. If there's specific FAQs that you referenced in your reporting or in the use of these funds, making sure you have those included in the supporting documentation, making sure that invoices are readily available, because if you had a lot of expenses, those might be tested as part of your compliance audit. It's also important to review your current policies and procedures and internal control processes to ensure they appropriately describe how the organization maintain the funds and use the funds in accordance with the terms and conditions. How did you capture expenses? What was your process for receipt of the payment, and to ensure that you all complied with the terms and conditions? And then review the compliance requirements and HHS guidance. I think the compliance requirements help you understand what is going to be tested as part of this compliance audit. I've included from the 2021 compliance supplement the specific compliance requirements that relate to the provider relief funds. So you can see there are 4 specific compliance requirements that will be tested. So reviewing those, and it gives you detailed information in that compliance supplement as to kind of the requirements related to each of those. We also expect the AICPA Government Audit Quality Center to issue additional guidance on audits for for-profit entities, so those financial audits. I think they're working with HHS currently on, what do those need to look like? What should that encompass? So we expect additional guidance to come out on those. Also wanted to point out quickly the due dates for compliance audits. A single audit is typically due 9 months after your year end. For June 30th, 2021 entities, there was a 6-month extension for those. We expect the financial audits to follow a similar due date, but I do expect more guidance from the AICPA and from HHS on that. Wanted to briefly go over phase 4 and American Rescue Plan rule funding. I know a lot of organizations are currently going through the application process for these funds, so just wanted to hit a few things on those. The phase 4 base payments are based on changes in operating revenues and expenses from July 1st, 2020 through March 31st, 2021, with smaller providers reimbursed for a higher percentage of their changes in operating revenues and expenses. So HHS is going to wait until all applications are in, and then they will look at the size of organizations as a whole to determine the payments for each organization. There's also bonus payments here and the rule payments that I mentioned as well, which are based on, if your organization provided services to rural patients for this period of time, January 1st, 2019 through September 30th, 2020. So organizations can receive both phase 4 and the rule payments. And as I mentioned in the beginning, the deadline for these is next week, so October 26, 2021. If you haven't gone in and looked at the application, there is a little bit of different information they're requiring to be provided from the previous phases. So some specific tax return information, as well as some reconciliations if needed. So, definitely need to go in and look at that if you think your organization wants to apply for those funds. There's also a lot of guidance on HRSA's website related to phase 4. If you have a complex reporting structure, if your entity doesn't have tax returns. So lots of guidance out there that is very helpful. And then phase 3 payment reconsideration. This is also out there where HRSA has provided detailed information on how those phase 3 provider relief fund payments were calculated. And so providers who believe that there may have been an error in their calculation can submit to have a reconsideration of that payment. So there's a PRF reconsideration request form out there that you would complete, and the deadline for that is November 12th, 2021. So this takes us to our second polling question. Do you plan to apply for phase 4 provider relief funds? Yes, no, not eligible, or not sure. So I think the key takeaways for provider relief funding is just documentation is key here. There's a lot of gray area. So just documenting your stance on, why you included certain expenses or your lost revenue methodology. Leverage HHS resources, and reach out to LBMC or your accountant if you have specific questions. Thanks so much, everyone. And I'm going to turn it over to Buck Freeman to talk about leases.
Good morning. Lease accounting. I know we're very excited about lease accounting. I know that it seems like I've spoken on this topic the last 3 catalysts. This is the 4th year. I know you're wondering, what could he possibly tell us today that we don't know or we haven't already heard? Well, we have at LBMC, we have helped several publicly traded companies and privately held companies already transition to these new lease accounting rules. And through that process, we've learned a lot. There's been a lot of additional guidance that's come out over the years. There's been a lot of lessons learned from our own assistance helping our clients. So there are some very helpful updates today that I want to provide, just some changes to the some ASUs, as well as an exposure draft. And then I want to just talk about some implementation lessons learned. Just a little bit about me. Lauren, go back 1 slide, sorry. Just a little bit about me, shareholder at LBMC, a little over 12 years experience. Worked in healthcare my entire career. I do a lot of accounting consulting around lease accounting, as well as complex transactions, business combinations, complex leasing transactions. Prior to LBMC, I have 4 years of software development experience, healthcare or a hospital IT company. Go ahead and advance the next slide. And for my regarding the agenda today, I just want to talk about initially just going to give an overview of the changes with this new standard. I know some of this will be repetitive, but I just wanted to hit the high points. I want to give an update of what's occurred since last year with the codification and an exposure draft, and then I'll dig into the implementation lessons learned. Just a quick overview of the changes. As we, are aware, presentation of our operating leases is going on the balance sheet. This is the biggest undertaking, the biggest change. We will have no change to our income statement or to our cash flow statement. So I know that's a question that I often hear, and as the private companies are preparing for transition January 1 of 22, that's a question I often hear is, I haven't, estimated the impacts to my EBITDA, or I haven't estimated, what this will do to any of my earnings metrics. Well, the good news is it's not going to impact this at all. You're going to continue to have straight line rent expense even after you've grossed up your balance sheet for these operating leases. We're going to have expanded disclosures. So you're going to be required to disclose the weighted average remaining lease term. You're going to be required to disclose the weighted average discount rate that you use to calculate those present value of those operating lease liabilities. There's a requirement to disclose a more or less a full rent reconciliation, where you denote the amount of expense that relates to capitalized operating leases and as well as other rent expense categories that that don't relate to those capitalized leases. And then there's more disclosure requirements just around the nature of leasing, the types, the classes of assets that you lease, whether it's medical equipment or manufacturing equipment, or power utility locations, or whatever it might be. Again, we do have some changes to our classification testing. So under 840, we had these bright line tests. 75% of the useful life test, the 90% test. Does the agreement contain a bargain purchase option? Consistent with 606, we're moving away from that rules-based, bright line-based accounting rules, and it's more principles-based. And so you'll see it more comes down to under 842, we're looking at what is the economic substance of this transaction. are we consuming the economic life of this asset? Whether through paying for it financially or through actual use over time, or do we intend to purchase the asset at the end of the lease agreement? And again, all that's based on the facts and circumstances at the day that you enter into that lease. And then we do have a new classification step for and this is more relates to equipment. Is the asset so specialized that it has no alternative use? And that would be if you had something custom built and somehow you negotiated a lease arrangement for it. It might occur in a sale leaseback type transaction. And then, no surprise here, but our effective dates for our private companies have moved back to 1/1/2022. And then for our public companies, they've already transitioned, and that was January 1, 2019. And just an update on the updates that have occurred since last year. So the first was ASU 2020-05, which it was as a result of the COVID pandemic, and that was a deferral, codifying the deferral of the lease accounting standard for private companies to January 1, 2022. The next was ASU 2021-05, and this relates to lessors, lessor accounting, and it relates to variable lease payments. This pertains to lessors with leases that have variable payments that do not depend on an index or a rate. So if you have, a lease that, if you're leasing something and all the payments that you're expecting to receive from the lessee are based on a percentage of sales or a percentage of some other metric that isn't an index or a rate, that would generally result in a selling loss day one of leasing that asset to that lessee. And that, this generally occurs when you have a longer term real estate lease arrangement. And it can occur in retail with common control entities. Sometimes it can occur with public utilities or, like a utility plant or, nuclear power plant, something like that. And the update to the guidance for this issue that was identified by users was that if it's determined that there's a day one loss in these arrangements, which really doesn't represent the economics of the transaction, nobody would lease something under the expectation that it would result in a loss. Those leases will no longer be classified as direct financing or sales type leases, where you would de-recognize the equipment or the property on day one. They will now be classified as operating leases. And so the lessor in these arrangements will continue to keep the real estate or the equipment on their books, and the variable lease payments will be reported to income as received on a periodic basis. So it's a nice some nice relief for those lessors that have a lot of these variable payment arrangements that are based on something like sales. Current project or exposure draft that's underway is discount rates for lessees. There's some relief that's coming for private companies. This is the result of the Private Company Council consensus. Currently under 842 private companies, they have the option to utilize a risk-free rate, which would be like a treasury, a T-bill or something like that. But they have to utilize that relief wholesale. So you have to apply it to all of your leases. So if you have some massive real estate leases and then you have some trivial equipment leases, you have to use that risk-free rate for all of those. Now, the trouble with that is that the risk-free rates are generally very low. And incremental borrowing rates generally are higher. And so the discounting effect of those using a risk-free rate is very minimal, which results in much larger lease liabilities, which could trip covenants or it could just cause an optical issue with your balance sheet. But now, as a result of this exposure draft, user or companies will be allowed to apply the risk-free rate expedient or option on an asset class basis. So most commonly what I would expect is that companies that have a lot of short-term equipment leases, like copiers and mailing machines, they will utilize a risk-free rate for those leases. And then for their real estate leases, which generally might be longer in nature and have much larger lease payments, they will utilize an incremental borrowing. Now, if this expedient or this relief is applied, you will be required to disclose that fact. But it's expected there will be no change to the weighted average discount rate calculation. The next thing I want to talk about is I want to dig into some of the implementation lessons learned. This is something that I've seen and I've helped implement with a few companies already, and I wouldn't generally discuss this as an accounting approach, but the FASB recently released an example on their website of applying this approach as an easy way to be compliant with 842. And they refer to it as the display approach. I would think of it more as a snapshot approach. That's what I would call it. But it's a way that you can kind of navigate around all of the monthly debits and credits associated with with each lease. Because if you think about it, every lease that you have every month, you probably have 3 to 4 to 5 journal entries that you have to record. And under this approach, you just look at your lease portfolio at each reporting period, and you record the ending balances. So I'm going to go ahead and, if we can, go to the next slide, Lauren, and we'll, in just a second, let's go back to the previous slide. But I just want to show go to the next slide, please. Yeah, so here this is just an example of a capitalization table or an amortization table. You would have one of these for all of your for every one of your leases, and the idea is that you would have a summary sheet that pulled the ending balances at each reporting period onto, go to the previous slide, Lauren, onto this slide, and you see that we're just pulling the ending balances. So this would be as of 12/31/2022 for each one of your leases. Note that all the leases have different discount rates, different terms, but we're just pulling the ending balance. And at the top, we're totaling what those ending balances are for the right of use asset, which is in that column H, and then the right of use liability, which is in column L. At the top, we're summarizing those in the journal entry format. So this would just be one journal entry that's reported at the end of each reporting period. Where maybe you do this quarterly, maybe you just do it once a year. I would expect that some of my clients that have smaller leasing portfolios probably just are going to want to do this once a year. So now you might notice that the right of use asset and the right of use liability are not the same amount, and that's because these leases have escalating lease payments, and so the difference there is as a result of additional lease payments or cash payments that don't equal the rent expense that's been captured. Because under this approach, we don't make any changes with 840. with our current accounting, we just record invoices as they're recorded, as they're received. And so as a result, you can see that we haven't recorded enough rent expense. And we could prove this out by looking at the the actual amortization tables and comparing those to the invoices that we received. But high level, this is the reason that we record the difference to rent expenses, because it's necessary to true up your straight line rent. It's a straight line rent adjustment is effectively what it is. Under this approach, you want to be mindful of prepaid rent or accrued rent payments. You don't want to double up. So I would expect that, the first time that you go through this exercise, you're probably going to analyze your prepaid balances as well as your accrued rent balances to verify that you haven't, doubled up on anything, or you don't have any adjustments that are needed. Perhaps you need to, you've grossed up a prepaid rent payment. So you've credited accrueds and you've debited prepaid expense. That's common. I see that all the time as an auditor. And so you just want to ensure that you've removed that just with a simple reclass entry. But perhaps you've already expended the cash, and you might need to adjust it to the P&L. Maybe you've got some kind of adjustment like that. So you just want to be mindful of what's already on the balance sheet for those operating leases when you take this approach. And that this is something that you can adopt. You can adopt this after you transition. You can take this approach at transition. So you have a couple options there. Again, this is intended to, and I think the reason the FASB released this was there was a lot of concern around all of the journal entries associated with, with this new standard. And so I think it's a nice, elegant approach to accounting for accounting for this. Laura, please go to the next slide. And again, this is just a visualization of what one of these capitalization tables looks like. This is something that you can get directly out of a software system. So if you're utilizing software for your lease accounting, they should be able to spit out a capitalization or an amortization table, which just shows you the burn down and the related rent expense every month. Or you can build these in Excel. Again, if you have, I've said this before, but if you have 25 or more real estate leases, you probably want to look at software. There's a lot of things that you can get out of software that will make your life a lot easier around business intelligence, renewals, square footage calculations. There's a lot of things that those software solutions that can provide that you really that can get a little unwieldy trying to use Microsoft tools. And here I just want to talk about some additional lessons learned. Deferred rent. I've spent a lot of time helping companies transition, and deferred rent is always an issue. It's something that always comes up, and because it's, what do we do with this balance? Well, on what should occur on a lease by lease basis is you should take that deferred rent balance and reclassify it to the right of use asset, and you amortize it over the remaining life of that lease. The trouble with that is that these software systems that that do all these calculations for you for 842, they typically calculate a cumulative difference at transition that does not equal what you've been maintaining in your Excel schedule for deferred rent. And I'm not surprised, because those schedules sometimes, there can be issues with them, or maybe there's just maybe a payment amount just got miskeyed. So to help relieve some of the issues around trying to manage the lease by lease deferred rent balance issue, I would recommend reclassing that balance in total as a single contract asset to the right of use asset and amortizing it over the weighted average remaining life of the assets that it represents. And so you might, typically equipment doesn't have, I've seen it before, but typically it doesn't have escalating lease payments. And so therefore you wouldn't have any deferred rent for equipment. So if you analyze your real estate portfolio and you see that the remaining useful life, or the weighted average remaining useful life of those your real estate leases at transition is 4.5 years, then I would reclass that deferred rent balance to the right of use asset as a contract asset, and I would amortize it over 4.5 years. I think I would be hard pressed to be convinced that doing it on a lease by lease basis would give you a much different result. The next is utilizing the portfolio approach for discount rates, asset classes, lease terms. You don't have to try to nail it with every single lease. Try to figure out the discount rate specific to every lease. I would, and what I encourage my clients and those that I've already assisted, with this standard is come up with establish your discount rates, once every 6 months or once a year or once a quarter, and utilize those rates, throughout that quarter. Don't try to, every time you enter into a lease agreement, just try to figure out, what that specific discount rate would be at that point in time. Just have an accounting policy and, keep it simple. The next is lease terms. You can go down a rabbit hole of trying to, analyze the lease term on anything that has a renewal, especially equipment, or, you can analyze history and know, what you know about your business and establish a policy on lease terms for, say you have a bunch of vehicles and they generally are, 40 to 55 months, something like that. And that you generally, keep those through the end of the lease term. You could just say generally that every vehicle that we get, we're going to utilize 47.5 months, just on average. That's what we're going to do. So you have that option to take a portfolio approach, establishing accounting policies for lease terms as well as discount rates. I would do this on an asset class basis. You're going to want to, at transition, I would coach you to disregard leases that expire within 12 months of adoption transition. So if you're a private company and you're transitioning January 1st, 2022, and you have a lease that expires on 6/30 or terminates on 6/30/2022, you can disregard that. You don't really need to do anything with that because, in my mind, that's a short-term lease. It's sure at one point it was a very long lease, but that amount, that 6 months of that lease is probably trivial in the grand scheme of things. So I'm coaching my clients to disregard those leases that expire within 1 year. And you think it's material, yeah, sure. Maybe you do an analysis to determine what the impact would be. But I definitely would not put those into a software solution because every lease that you put into a software solution, they're going to charge you for that. Every month they're going to be hitting you for $6 to $10 per month per lease. So if you can keep those out of that solution, I would. And that's also for, vehicles, copiers, mailing machines, things that you have a large volume of, that you can get the data in a spreadsheet from the vendor or from the lessor. Do the analysis in a spreadsheet, especially if you're going to take the display approach to accounting, and you can just maintain that on a quarterly basis. Just get that data updated from the lessor periodically. Do not attempt to utilize, I would not recommend you to utilize the practical expedient to reassess lease terms. Unless you have some business reason for wanting to do that, I would encourage you not to. You have the way the transition guidance is written is you don't have to reassess lease terms at transition. And so I would not do that. I would just grandfather in the lease term that you established under 840, grandfather that into 842. And then once you get under 842 and you renew that lease, then you just then it's a lease modification and you create a new asset or a new lease for 842 purposes. The last thing is just consider capitalization thresholds. I think about capitalization thresholds as a, percentage of total assets, and your total assets, depending on the amount of right of use assets that you're going to be reporting day one, are going to go up a bunch. It could go up, enormously if you have a ton of real estate leases. So reconsider that capitalization threshold as a percentage of your total assets, and perhaps this is an opportunity to refine that. Go from $1,000 to $5,000. Just that's something to think about. And then also materiality thresholds. Sure, you got a bunch of hand sanitizing machines around your headquarters, but in the aggregate, are they really worth the effort to determine the lease accounting impact? I would think not. So have some kind of management materiality threshold for what's meaningful to our business. What do our readers really care about? Do they care about Coke machines, or name your trivial lease, because we have leases all around us, and so just reconsider those thresholds. I think we have a little time left for some questions.
Yes, Buck, I saw a few come in for you and Courtney. Courtney, do you want to kick it off and answer one of the questions?
Sure. I think the first question I saw related to provider relief is, we received provider relief funds and used for staff retention. How long do we need to keep records for that? So there is a specific frequently asked question out there regarding how the retention of records, and it says that you should keep your records for 3 years from the date of the expenditure.
And Buck, I saw one come in regards to your presentation. We can just kind of go back and forth, but the one that came in for you was, have you seen banks being hospital for the snapshot approach as part of the covenant reporting?
That's a great question. So I actually gave a presentation to some bankers probably a month ago, and the reaction that I heard was some of the things I heard were, we didn't realize that we were going to be grossing up our balance sheet. We didn't realize the effort that went into this new standard. We didn't realize the transition date, et cetera, et cetera. So my gut feeling is that the bankers don't care about the mechanics of how we get the accounting reported. I wouldn't recommend the snapshot approach if I felt that it was going to create errors, or if it was wrong. I think it's correct. I think it's just a simpler way to get there. So I'm not aware of, I have a client that's currently using this approach, and they have covenants, and they haven't mentioned anything to me about it. So I wouldn't foresee any issues. Again, I don't think the banks care about the mechanics. If you're reporting covenants on a quarterly basis, then you probably want to take a snapshot every quarter. That would be my guidance. But yeah, that's a good question.
Courtney, there was another one that came in regards to your presentation. Let's see.
I think there's a couple. One asks for access to the lost revenue guide. It's on the HRSA website. We'll get with this specific person and can send that lost revenue guide over. I did see another one related to a June 30th year-end company. So it says, if we were under 750,000 at 6/30/21 and didn't need to do a single audit, but go over 750 with phase 4, will we now need to do a single audit? It all really depends on the amount of payments for each period. So you did not reach the 750 threshold for period 1, for 6/30/2022, we're waiting on that 2022 compliance supplement will come out and tell us what's going to go on that CFA to determine if you meet that threshold. I'm guessing it will be period 2 and period 3 payments. So if those two aggregated to 750,000 or more, you would have to have a single audit for 6/30/2022. And then likely phase 4 payments, we'll wait to see, will those actually go on your 6/30/2023 CFA? So more guidance to come on that.
Buck, another
Yeah,
question.
Lauren, it looks like there's a question about month-to-month leases.
Yep.
So how do you classify office leases that are month-to-month? So if you have the question that I usually respond with month-to-month leases is it truly a mutually cancelable lease where either party can exit the lease, at the end of the month? And if that's the case, then that is truly a short-term lease. And you don't need to do anything from an accounting perspective. Now, if the cancellation is one-sided, then you have to assess that, differently. If it's an office lease and you truly have a month-to-month lease, I would challenge you to look at the cancellation provisions and then also analyze, what are your investments in that office? Because if you're gonna lease some office space, I imagine you're going to invest in possibly some sort of improvements to the space. Does it make sense to really spend, $100K on improvements to an office space if you're only going to stay there for a month? So, again, it comes down to principles approach of like, what's the economic substance of the transaction? Office leases that are truly month to month, I see those in, sometimes they're related party transactions. So they can be a little squirrely. I'm happy to just look at it. If anybody would like to, reach out to me, I'm happy to look at it with you. What are the most common types of embedded leases and how have you seen materiality applied to those? So common in the healthcare space that I see are reagent machines. Typically, those arrangements are structured as, a placement agreement where they bring you a piece of equipment for free. And you sign up to purchase consumables from them for, 3 to 4 years, and you have a purchase minimum. So you got to spend, $20,000 a month with them. So in effect, that equipment really isn't free. And so you have to, this is an analysis that our team has done on a few occasions to dig in and like determine, okay, what is the actual cost of the equipment? What is the cost of the consumables? Because that consumable price includes the equipment. It's generally going to be, there's some dollar threshold, and that's something you got to talk to your auditors about is, and again, this is one of those things where you can take a snapshot approach. You just report it once a year, if it's determined to be material. Another thing is like, if you have some sort of storage space where you keep records, you pay for record storage at Iron Mountain, that can be considered some type of embedded lease. I've seen garbage dumpster situations where they don't substitute the dumpster. You have exclusive, like you effectively use the same dumpster. That can be considered an embedded lease. Cloud storage in some instances can be an embedded lease. So, there's a lot of situations, vehicle, like transportation agreements, billboard agreements, things like that. You think they're advertising arrangements. This is how I like to categorize embedded leases. They are any agreement that your organization has that's not with an employee and is not labeled a lease agreement. So anything else is subject to, this quote unquote embedded lease analysis. So it's kind of open-ended, but I think it's a question that you definitely should have with your auditors or have someone else look at it to help you there.
Thanks, Buck. That's all the time we have for today. So thank you, Buck. Thank you, Courtney. And thank you all for joining. We hope you enjoyed this session. If there were any questions we didn't get to answer, I think we answered the majority of them, but we will reach out to you directly. You have a great day.